Hey traders, hopefully you're having a good week so far. We're not really going to go over too many charts today on TradingView, looking at some price action, but we're mainly going to be looking at some fundamental factors, going over a bunch of different stuff on more of the fundamental side of things. So let's first look at the economic calendar for the day. We got some PMI numbers, both manufacturing and non-manufacturing. The manufacturing one came on Monday. Not a lot happened on Tuesday other than the GDP for Australia. The forecast was 0.3 and the actual was negative 0.3, so not a whole lot of interesting stuff happening there. We got another PMI, a service PMI for GDP, and then the main thing is a non-manufacturing PMI, which was better than the forecast, and then the non-farming employment was actually substantially better than the forecast. They were really looking like it was going to be a really negative number, but with over 9 million, but 2.76 is not that bad comparatively, I guess, if you're looking at that. And then we'll look over those very shortly. And then the main thing that I'm going to be looking for on Friday is going to be the unemployment rate for the United States, non-farm payrolls. Initial job claims doesn't really affect the market so much that I've seen so far. The market really doesn't do a whole lot. It's absolutely tanking. Market goes up, so there's no huge shift that I think will happen from this, but I think Friday will be a big day for the markets. And then let's just quickly go into the Purchasing Managers Index. This is the manufacturing, and then we can see that it's not too bad. It's way above what we were at in 2009, back in the financial crisis, and we see that we've definitely had low points way lower than what we're currently at right now. So it's not that bad, and then this is the non-manufacturing PMI or Purchasing Managers Index. And this one is not that bad. It was an increase from the previous, which was at 36, or sorry, that was a forecast. It was at 41 and now it's at 45.5. We can see that the low of 2009 was like 30, 40, somewhere around there. So we are better than the great financial crisis, but definitely still digging deep here. And we can see it starts to gradually fall here, but then in the current situation, it was just an instant plummet. All right, last thing within the economic calendar is the non-farm employment change. We can see it's not that bad compared to what we had for last month, but we can see that it's still worse than, let's say, 2001 or even 2009 in the financial crisis here. So it's definitely still worse than really the past handful of decades, but it is looking better for the jobs compared to last data set here. It was really, really bad last time. It literally broke the chart. So that's a little bit of the economic news for the start. We are going to be looking at Friday for that unemployment number. And then just a quick update for the monetary base. This is the amount of United States dollars in circulation, or the amount of money that they've printed. We can see it is slowing down a little bit, but we're still seeing higher highs come into the market here. And it has stalled out a little bit from May 13th to May 20th. We haven't really seen any money printing from that point on. But obviously we can see that if you do take a step back, it does look like it's basically like a straight line up. And then we can see that this is now from just America, this is now global, and this is percentage for the money supply increase or decrease, but I like to look at the 3-month change, which is a quarter, and the 12-month change. So let's just first look at the 3-month change. We can see that America is in double digits, and there's not a lot of countries that are actually in double digits. We see Mali, Luxembourg, Sudan, there's like places like Brazil, Colombia, Turkey, Argentina. USA is kind of the outlier in this list, and they're at basically 12% increase in money supply within the last quarter. And then if we go to the last 12 months, we see USA again at 18%, almost 20% increase in the money supply in the past year. We see places like Venezuela have over 1,600%, Zimbabwe at 244%. But if we go in the 3-month change, it doesn't seem that far off. We're at a current 12%. Turkey, that is seeing some significant inflation, is at 17%. And we'll look at the interest rate that the Turkish lira that is taking place, because obviously if you have extremely high inflation, you want to try to lower the heat level within that economy, and that would basically be by raising interest rates. All right, so let's look at some of the money supply that we can see. I picked Venezuela, Zimbabwe, Argentina, America, just to get a good understanding of how the charts look. So this is first Venezuela, money supply in billions. We can see it's really just absolute parabolic. We can see that it's at 10,000, 15,000, 22, 31, 40, 59. It's just going parabolic. Zimbabwe is a very similar situation. Venezuela is way worse. You can't even see the numbers back in 2015, 2017. Zimbabwe, you can, but it has substantially increased in terms of the money supply. Argentina as well, they were somewhat stable, we can see here, compared to what we have right here in terms of the overall money supply. This is South Africa. Their rand is depreciating against the United States dollar pretty quickly here as well. But we can see America has a very similar chart. So yes, if you are comparing the South African rand or the Turkish lira, the Turkish lira, South African rand does look like it is devaluing, but the United States dollar is devaluing a lot as well. We can see that it's only going up, and recently it's just basically going straight up in a straight parabolic move. So, probably not the best place to keep your money for a long period of time. This is now going to be looking at the central bank current interest rates from a different list of central banks here. And basically everyone is lowering their rates except really for Sweden. They were at negative rates and now they're at 0. But every single other nation and central bank is lowering their rates. Direction is all going down. We can see even the higher inflation countries, are lowering their rates. Turkey has a current rate of 8.25, even though their inflation rate is a substantial amount. They do have a decently high interest rate because they can't just let it go off the run. It will just hyperinflate like no tomorrow if they have a very, very low interest rate there. So we can see overall very low interest rates. You do have to keep in mind, if you are trading FX with currencies that have high interest rates, you will have carry costs, so keep that in mind. So let's say if you're short Turkish lira and long the US dollar, you're borrowing with a higher currency rate or current rate than the United States dollar, something to keep in mind. And this is the CPI numbers, Consumer Price Index. This is a gauge on inflation, and it makes sense that there's not a lot of currencies that are actually inflating. There's a lot of deflation going on, and that totally makes sense, right? Less people are spending money, less people are spending money on goods and services. There's less velocity going around in any of the currencies, which is deflationary as a result. And then we see that there's a lot of negative numbers here on the monthly basis, which does not surprise me one bit. The only real country that's still seeing a decent amount of inflation overall, we see India almost have 1% in terms of the CPI, and Turkey is almost at 1% as well, but there's not really that many countries that have any sort of increase in the CPI or increase in inflation. And America is definitely would want to see that, 2-3% inflation a year. And I think they will try really, really hard to get that inflation by printing more and more money, by trying to stimulate the economy, by getting people to spend more and get that whole economic cycle going. In my personal opinion, Keynesians love that slow inflation taxation on the savers. Now we're going to be going into the different types of unemployment rates. We see that U3 is the official unemployment rate at 14.4 or 14.7, I should say. U5 includes discouraged workers and all of the marginally attached workers, and then U6 adds those workers who are part-time purely for economic reasons. And U6 at 22.8%, and we see it go up quite significantly here. This number will change depending on the numbers on Friday. We can see that the forecast is set to be almost at 20%, which is pretty unbelievable. So we'll see how that goes. That's going to be a huge move towards the upside, and we'll see how the U6 and U5 are going to be looking like with that data set. So with all these people unemployed and unable to pay for their mortgages, obviously it usually ends up back at the commercial banks, because if commercial banks are loaning for mortgages, auto loans, all that stuff, and people are losing their jobs and can't actually pay for the loan, or at least pay minimum payments or something. There's going to be delinquencies, there's going to be non-performing loans, and we'll get into that right now. But we can see since 2008, the commercial banks have been increasing the amount of money that they're providing for real estate loans. So there's a lot of money in the system, a lot of leverage used, obviously, and I think if it does start to move to the downside, banks are really going to get squeezed. And this is now going to be looking at the non-performing loans for commercial banks in the United States. So this chart is going to go up before the delinquency rates, because this is just showing the non-performing loans that are past due 90 days or more and still occurring. So, this will start to spike once we start to see Q1 numbers, especially Q2 numbers and Q3 numbers. I think this chart will start to see an increase. This is quarterly results or quarterly data set that is provided, so it doesn't come too often. But I think this will show some important things related to the banking sector and things that we could be looking out for a potential next leg down. I'm still not 100% convinced that the market is going to go back up. We're going to hit all-time highs and then some. It just, to me, does not make sense. Yes, I understand that there's a small group of companies that is basically carrying the entire index, but in terms of the overall outlook of the United States economy, I can't say it looks bullish. All right, delinquency rates on all loans. So this is the non-performing loans. This should spike first because obviously a loan turns to a non-performing before they completely create the status of delinquency. And saying that it's delinquent, it has not been able to be paid, and they're not going to pay. So this is like the final end of the loan, whereas this is still holding on. They think they can do it. They may restructure, whereas delinquency rates just mean that they haven't paid and they have no money to pay. So the non-performing will spike before the delinquency rate chart. Now let's look at what happened before. So this number is going to give us the delinquency rate, and we have different columns here. This is for all residential, commercial, farmland, and then we have consumer loans for credit cards, other, all, leases, C&I loans, agricultural loans, total loans and leases. The main thing we're going to look at just for ease of use is going to be this all in real estate loans, just because it's going to go through the residential, commercial, and farmland, but we'll look at these three numbers here for real estate loans mainly. So let's go back to 2006, 7, 8, 9, kind of when the financial crisis was at its worst. We can see that back in 2004, 2005, overall, things were looking really good. The delinquency rates were at low to mid 1%, 1.3, 1.4, 1.3, 1.4, and then it started increasing in 2006 in the third quarter, 1.5, 1.7, 1.77, 2 in 2007, Q2, 2.4 in Q3, 2.9 in Q4, 2008, 3.5, and it started really shooting up in 2008, 4.2, 4.8, 6, 7, 8, 8, 9, 10. So it increasingly got really, really bad for delinquency rates within the United States for all banks regarding real estate. And we can see it's a very similar structure within residential and commercial. We're in the low ones, and then we start increasing, and we can see that the residential got higher in the delinquency rates compared to the commercial. But I think in this case, in this current market, commercial is definitely potentially going to be a higher delinquency rate because obviously people are still living in their rental properties or mortgaged houses or whatever, but businesses can no longer currently run with the lockdown. So this number is going to be pretty big in my opinion for the next couple quarters for 2020 into Q3, depending on how bad it does get for the lockdowns with the riots and looting and everything. Obviously that's pretty bad for commercial real estate. So we'll keep an eye on that, but I thought it was pretty interesting to see how the ramp up went in 2006 and onwards, and how it kind of diffused back into 2015s, where we went from double digits at 10%, down to the 8, 7, 6s, 4, 3, 2, and now we're all the way down at 1.5 at the end of 2019 in Q4. So in terms of delinquency rates, it was looking very, very healthy with a very low 1.5% back in what we saw in 2004, 2003, 2005. It's definitely a lot better than what it used to be, but I think we could start to see that number rise. Remember, it did take quite a while for the delinquency rates to peak at over 10% double digits, whereas the real move started kind of in end of 2008, end of 2009, right around here. So it took a couple quarters for it to really sink in the market and for us to get our worst number so far. Something to note. All right, so now we're going to look at some of the stress tests that we're going to be looking at. This is the first one, the St. Louis Fed Financial Stress Test. It goes back all the way to 1994. There hasn't been a whole lot. 2000s actually wasn't that bad at all. We can see that this was the dot-com bust right around here, 2000, and then this is that huge bear market. And this is 2008, obviously a huge spike in the stress in the financial markets. And then it did look really bad initially back in March when we had that initial sell-off, but it is retracing back underneath that 0% line quite quickly. And I think if we do get back down below there, basically means that we're seeing less stress than average. At the end of the day, we can see that this chart measures the degree of financial stress in the markets and is constructed from 18 weekly data series, all of which are weekly averages of daily data series, 7 interest rates, 6 yield spreads, and 5 other indicators. And it's decreasing quite substantially here. Let's just bring it over there and then see what we can find within the current structure. So we're almost at that 0 mark, but a lot of stress initially at that sell-off. But the stimulus definitely saved the day on that one, and we can see it's coming right back. We're easing in the stress levels. It overall looks somewhat steady in the markets, it seems. Next thing we're going to look at is the Chicago Fed National Financial Condition Index. This is also somewhat of a stress test. And we can see this provides a comprehensive weekly update on the U.S. financial conditions in money markets, debt, and equity markets in the traditional and shadow banking systems. 2008, yet again, big pop, but what we saw recently in March did not actually push this nearly as high as what we saw in the St. Louis Fed Financial Stress Index, where it was a huge push up, kind of mimicking what we had in 2008. In terms of the aggressiveness, but we can see in this chart, not really seeing that push to the upside. We're not even above the 0 mark, which is that black line right there. So in terms of this chart, the Chicago Fed National Financial Condition Index, it does not seem to be that stressed out in terms of the markets, whereas this, definitely a little bit worrying because we can see if it's above 0, definitely looks like there's some worrying to go about. We can see that there was a pump, and then we had their massive move that occurred back in October of 2008. You know, if you're just extrapolating what happened in the past, you could say that this is our first pump. We would have multiple more, which in my opinion is a higher probability than just us going and continuing our slow grind to the upside and then we hit all-time highs and we just continue going on. I just can't really see that happening with so much happening in the markets right now, but hey, I'm going to sit out and trade other markets until the S&P kind of, in my opinion, is a little bit more in my favor with the bias that I am looking at. So that's the video for today. We didn't really look at any of the charts, but it was a lot of charts that wasn't really price action. It's more representing some level of data that we're able to use and try to understand the world we live in today. So thank you very much for watching. If you found it useful, educational, entertaining, it'd be great if you would subscribe. If you like the video, give it a thumbs up. That would be great. And we'll see you next time. Hopefully you have a good week trading for the rest of the week. And we hope you have a fantastic day. Bye-bye.